The critical question facing every investor today is clear. Are we heading for a market crash or continued prosperity? Consider this striking contradiction. Unprecedented levels of uninvested capital remain on the sidelines, suggesting massive potential for market growth. Yet simultaneously, the financial foundation of average Americans is eroding as they struggle with basic expenses. This fundamental disconnect demands our attention because understanding this paradox is essential for protecting and growing your investments in these uncertain times. Look around, confusion dominates the market landscape right now. This uncertainty isn't surprising given the mixed signals we're receiving. Despite all available information, even seasoned investors cannot confidently predict the stock market's next move. The question isn't if volatility will continue, but how we should position ourselves amid this unpredictability. You're sitting in front of your computer, watching the stock ticker scroll on the screen. Green means prices are up, red means they're down. And with every minute, it feels like the entire economy is moving, all driven by millions of strangers buying and selling invisible shares of companies you probably know and use every day. But how did the stock market get to this point? Why does it exist? And who decided this massive, chaotic system is how we manage wealth and economic growth? One pivotal example of the stock market shaping history happened during the Industrial Revolution. Think of steel magnates like Andrew Carnegie or oil tycoons like John D. Rockefeller. These individuals used the stock market to expand their businesses and, frankly, amass enormous wealth. As companies grew, investors who took early chances on these industries often reaped huge rewards. But the flip side? Speculation also grew, and many people lost their life savings chasing bad investments. By the 20th century, the stock market was becoming more sophisticated, though not without its flaws. One infamous example is the stock market crash of 1929. In the Roaring Twenties, everyone seemed convinced they'd get rich from stocks. Regular people, teachers, factory workers, even farmers, started putting their savings into the market. The problem was that much of this investing was done with borrowed money. When prices stopped climbing and began to plunge, the entire system crumbled under the weight of debt and fear. The Great Depression that followed left millions unemployed and taught the world some harsh lessons about how fragile the market could be. In more recent decades, technology transformed the stock market yet again. Remember the dot-com bubble of the late 1990s? Companies like Amazon and Google were just starting out, and investors poured billions into internet startups, believing they'd redefine the economy. And many did. Look no further than Jeff Bezos or Elon Musk as proof that some risks pay off in extraordinary ways. But others were little more than a dream, or worse, scams. When the bubble burst, thousands of these companies folded, taking investor dollars with them. Today, we're in the era of algorithmic trading, cryptocurrencies, and apps that let anyone, yes, even you, invest with just a few taps on your phone. Take Robinhood, for example, one of the most popular investment platforms of the last few years. It democratized trading, allowing people who'd never bought a stock in their lives to suddenly participate in the market. But this accessibility has also created problems. Inexperienced investors often underestimate how risky the stock market can be, especially during events like the GameStop frenzy in 2021. Remember that? A subreddit called Wall Street Bets orchestrated one of the largest short squeezes in history, sending a struggling retailer's stock soaring and appending hedge funds that had bet against it. As of right now in 2025, we have some key things that are driving the market at this time. 1. Interest rates and Federal Reserve policy of the Federal Reserve continues to be a major influence. In 2025, markets are reacting closely to whether the Fed will cut rates, hold steady, or possibly raise them again depending on inflation trends. High interest rates typically weigh on tech and growth stocks, while rate cuts often boost them. 2. Inflation trends. Inflation has cooled from its 2022 to 2023 highs, but it's still a top concern. CPI and PCE reports, consumer price indexes, are closely watched. Sticky inflation in sectors like housing or energy can delay Fed rate cuts, which affects market sentiment. 3. AI and tech boom. Companies tied to artificial intelligence, like Nvidia, Microsoft, Alphabet, AMD, continue to drive major market moves. The AI arms race is fueling investor enthusiasm and reshaping the tech sector, similar to the dot-com era, but with more fundamentals. 4. Corporate earnings reports, quarterly, drive short-term price movements. Sectors like semiconductors, cloud computing, energy, and consumer discretionary are in focus depending on macro trends. Ongoing conflicts, e.g., Ukraine-Russia, Middle East, Taiwan-China tensions, can cause volatility, especially in energy and defense stocks. Markets are sensitive to supply chain disruptions or changes in global trade policy. 6. Presidential election year, U.S. 2025 is the year following the 2024 U.S. presidential election, and markets tend to reflect policies of the new or continuing administration. Policies on corporate taxes, regulation, green energy, and tech are all being priced in. 7. Global economic growth, slowing or accelerating growth in China, the EU, and emerging markets affects demand for goods and commodities. The IMF Global Outlook and GDP forecasts shape investor sentiment. 8. ETFs, passive investing and algorithmic trading, structural market dynamics, such as ETFs, index funds, and AI-driven trading algorithms, also add momentum or volatility. The stock market's roller coaster won't stop you from building wealth in 2025. Your path to accelerated financial growth has 3 critical steps. First, develop a smart system for investing your money strategically. Second, train your eye to spot those hidden gems of opportunity that emerge during economic shifts. And third, master the art of investment research, because knowing how to properly analyze potential investments separates the successful from the simply hopeful. When debt consistently outpaces economic growth, the mathematics become unforgiving. We cannot ignore this fiscal reality any longer without facing severe consequences. It's hard to miss the chatter about America's national debt in recent years. But the truth is, ballooning debt isn't new. In fact, history has seen moments where the national debt surged far beyond the growth of the economy. Take the aftermath of the financial crisis of 2008 as a textbook example. Let's set the stage. The 2000s had been riding high on the dot-com boom and housing market frenzy. But then, in late 2007, the cracks began to show. The housing bubble burst, Lehman Brothers collapsed, and the global financial system was thrown into chaos. By 2008, the United States found itself plunging into the Great Recession, a dark and uncertain economic period. The recession wasn't just an economic slowdown. It was a seismic shock to America's confidence. Unemployment hit 10% in 2009. Home prices tanked. Foreclosures skyrocketed. The economy was contracting, businesses were shutting down, and families were struggling to get by. Something had to be done, and fast. So the government stepped in with unprecedented measures. Congress authorized the $800 billion stimulus package under the American Recovery and Reinvestment Act. Then there was TARP, better known as the Troubled Asset Relief Program, a $700 billion bailout for Wall Street and auto manufacturers. And if that wasn't enough, the Federal Reserve unleashed quantitative easing, pouring trillions of dollars into the economy to prop up credit markets and stabilize the financial system. All of this spending came with a hefty price tag. Between 2008 and 2010, the national debt climbed by nearly $4 trillion, reaching over $13 trillion by the end of 2010. To put that into perspective, the nation's debt to GDP ratio increased from 68% in 2008 to 90% by 2010, a dramatic rise. The debt was growing far faster than the economy, which was limping along with weak recovery and sluggish growth. So, why was this happening? The obvious answer: the government was borrowing enormous sums to keep the economy afloat. Stimulus checks were being mailed out, unemployment benefits extended, infrastructure projects funded, and banks bailed out. Meanwhile, tax revenues had plunged, as businesses made less and workers earned less during the recession. It was a classic case of spending outpacing income, only on a national scale. Critics warned that such debt levels were unsustainable, that they would lead to inflation or sky-high interest rates. But at the time, policymakers had little choice. Immediate action was necessary to prevent a full-scale depression. And you know what? It largely worked. By 2011, the economy had clawed its way back to modest growth. But that growth couldn't keep up with the surge in debt that had been amassed in just a few short years. The aftermath of the 2008 financial crisis was a bold and sobering reminder of how fragile economies can be and how government intervention, while necessary, often comes at a long-term cost. In moments of crisis, the debt grows fast, but the economy doesn't always follow that same pace. And for America, this pattern was etched into its history once again. Stock market plummets 10% in single day. You rush over to your brokerage app, and sure enough, your favorite investments are deep in the red. Your portfolio looks like it's free-falling, and panic sets in. You frantically wonder, should I pull out everything before I lose all my money? If that scenario sounds familiar, you're not alone. Stock market downturns can make even the calmest investors feel uncertain and fearful. But here's the truth, those moments that feel like absolute chaos, they aren't the time to panic. In fact, they're some of the best opportunities to grow your wealth. Market downturns are normal. Yes, normal. Let that sink in for a moment. When markets drop, it's usually due to a mix of reasons: economic uncertainty, changes in interest rates, geopolitical events, or even just investor behavior. Sometimes the drop is dramatic, like the 2008 financial crisis or the pandemic crash in March 2020. Other times, it's just a correction, a pullback of 10% or more after the market has been tearing upward for months or years. No matter the cause, the one thing you need to know is this: downturns don't last forever. Historically, market crashes are almost always followed by recoveries that push the stock market to new highs. For example, after the Great Recession of 2008, the S&P 500 didn't just recover, it tripled in value over the next decade. And when the market dropped over 30% in March 2020, it rallied back just months later, reaching new record highs. So, what should you do when the market dips? First, it's essential to stay calm. Remember, you only lose money if you sell your investments during a downturn. As long as you don't sell and your investments recover, the loss is only temporary, just numbers on a screen. Here's the real secret to mastering downturns: see them not as threats, but as chances to buy. When markets dip, stock prices often fall below their intrinsic value. Think of it like a high-end store suddenly putting its items on a massive clearance sale, those same stocks you thought were too expensive last month. Now you can grab them at a discount. This is the principle of buying the dip. Legendary investors like Warren Buffett live by the mantra: be fearful when others are greedy, and greedy when others are fearful. Buffett and other successful investors know that downturns create opportunities to buy great businesses at lower prices. It's counterintuitive, but when average investors are panicking, savvy investors are shopping. Let's say you believe strongly in a company like Apple or Microsoft. During a downturn, their stock prices might drop alongside the broader market panic. If you did your homework and you're confident they'll continue to innovate, grow revenues, and dominate their industries, a downturn might be your chance to buy more shares at a discount. You're not just investing in what's happening this week or this year, you're betting on where these companies will be 5, 10, or 20 years down the road. So, how do you become smarter with your investments during these times? It all starts with knowledge. Before a downturn happens, you should already have a framework for analyzing your investments. Here's a simple checklist. 1. Understand the basics. Look at the fundamentals of the companies you're invested in. What's their revenue growth? Are their profits consistent? Do they have a clear competitive advantage? If you're confident in the business itself, short-term price movements don't matter much. 2. Think long-term. Investing isn't about picking the hottest stock for next week. It's about owning pieces of companies that will grow in value over years and decades. Ask yourself, can you see this company thriving in the future? Will it still have loyal customers, valuable products, or innovative strategies? 3. Diversify your portfolio. Don't put all your eggs in one basket. By spreading your investments across different sectors and types of assets, like stocks, bonds, and index funds, you protect yourself from the sharp drops of any single investment. 4. Don't let emotions drive decisions. When you're seeing red across your portfolio, it's tempting to sell everything just to stop the pain. But take a step back, look at the big picture, and remind yourself what history teaches us: markets rebound, profits grow, and patience pays off. 5. Keep cash on hand for opportunities. One of the best ways to take advantage of a downturn is to be prepared for it. Keep some cash or liquid assets available so that when stocks go on sale, you're ready to buy. Of course, none of this happens in a vacuum. You need to be disciplined and stick to your game plan. Remember, successful investing isn't about avoiding downturns, it's about knowing how to handle them. Let's briefly talk about mindset. When the market is in turmoil, it can feel overwhelming to see headlines about recessions, layoffs, and global uncertainty. But the key is to think like an investor, not a spectator. Instead of focusing on today's news, focus on tomorrow's growth. Realize that the short-term noise often overshadows the long-term opportunities. To give you even more confidence, consider this one fact from decades of stock market history. The longer you stay invested, the better your chances of producing returns. Over any 20-year period, the U.S. stock market has never had a negative return. Even through wars, economic collapses, and pandemics, it's consistently moved upward over time. Staying the course works. So, what does this all lead to? The next time you see the market drop, ask yourself these 3 questions. Is this an opportunity to buy at lower prices? Have the companies I've invested in strongly changed in any fundamental way? Am I clear on my long-term plan? If the answers lean toward optimism, don't let fear dictate your decisions. Instead, use these moments to strengthen your investments, deepen your knowledge, and set yourself up for success. And remember, wealth building isn't about avoiding risk, it's about managing it wisely. Downturns are simply part of the journey. They can shake your confidence, but they also create incredible opportunities for you to learn and grow. So stay calm, stay informed, and stay invested. The next time the headlines scream about market turmoil, remind yourself of this truth. Each crash is fleeting, and every recovery has created new opportunities. The question isn't whether the market will rebound, it's whether you'll be ready when it does. While history offers valuable lessons about tariffs' impacts, uncertainty remains inevitable, which is exactly why mastering the art of sophisticated, emotion-free investing is your greatest asset. The most successful investments rarely follow a straight upward trajectory. Your ability to identify promising opportunities and maintain unwavering discipline, especially during 2025's unpredictable landscape, will ultimately determine your financial success. Don't let market chaos distract you from this fundamental truth. Sure, it's not perfect. There's risk, greed, and moments of chaos. But it's also a system that rewards innovation, connects us to global industries, and helps individuals take ownership of their financial destiny. So, next time you watch that ticker scroll across your screen, take a second to appreciate the centuries of history that brought us here, from merchant ships to dot-com dreams. The stock market isn't just a collection of numbers, it's a reflection of human ambition, progress, and sometimes, our mistakes. The question is, what role will you play in its story next? Let us know in the comments below. Thanks for watching. Until next time.